Ladies and gentlemen, good day and welcome to the ADF Foods Limited Q4 and FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Irfan Ryan from Orient Capital. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone. On behalf of ADF Foods Limited, I extend a very warm welcome to all participants on Q4 and FY23 financial result discussion call. Today on the call, we have Mr. Bimal Thakkar, sir, Chairman and Managing Director, Mr. Shardul Toshi, CFO, Mr. Devang Gandhi, COO, Mr. Sumit Thakkar, Senior Manager, Business Development and Strategy. I hope everyone had an opportunity to go through our investor deck and press release that we have uploaded on exchanges and on company's website. I would like to give a short disclaimer before we start with this call. This call will contain some of the forward-looking statements which are completely based upon our belief, opinion, and expectation as of today. These statements are not a guarantee of our future performance and involve unforeseen risks and uncertainties. With this, I hand over the call to CMD, sir. Over to you, sir. Thank you.
Thank you, Irfan. Good evening, everyone. I'm pleased to welcome you all to our Q4 and financial year ended 31st March 23 earnings conference call. It gives me great pleasure to announce that the FY23 standalone and consolidated revenue is the highest in the history of our company. Also, the standalone and consolidated PAT for the year is the highest in the history of our company. This shows that the demand for our product continues to remain strong, and our efforts to improve the product portfolio, introduce new innovative products, and meaningful investments in marketing are giving positive results. On a standalone basis, we recorded revenue of 353 crores for the financial year 23, an increase of 17% year on year. Standalone EBITDA and PAT for the year are rupees 76.8 crores and 60 crores respectively. I'm pleased to announce that the board has recommended a dividend of rupees 5 per share. Also, the board has approved the subdivision of the equity shares of the company having face value of rupees 10 each into shares having face value of rupees 2. During the year, we've launched 35 new products under our flagship brand Ashoka and have forayed into 2 new categories, plant-based meats and frozen desserts. Our flagship brand Ashoka has now crossed 200 crores in revenue, growing at a CAGR of 33.2 over the last 2 years. We continue to strengthen the brand with meaningful advertising and marketing that will lead to an increase in shelf space. Further, the board has approved investment in Telleric Foods India of up to rupees 5 crores in 50 lakh optionally convertible redeemable preference shares having a face value of rupees 10 each, considering the future business plans of the subsidiary. This is a strategic investment to develop the sole brand over the coming years. The company is targeting more D2C listings and is looking at extending its product offerings with an urban-centric focus. During the year, and particularly in the last 2 quarters, we have seen softening on freight costs, which have had a positive impact on our margins, and we are monitoring these costs closely. There are a few inflationary pressures on some key raw materials in the same quarters, but we are working on mitigating them by continuing cost optimization, better product mix, and improved operational efficiency. On the operational side, we completed debottlenecking efforts at our existing plants in Nadia and Nashik. We have incurred a capex of 5 crores, which will yield a potential revenue of 30 crores. Our greenfield expansion in Surat is expected to be completed within 18 months from the time we break ground, which is anticipated in Q2 of financial year 24. The growth will expand our frozen food capacity and unlock the next level of growth. On overseas operations, we have made significant investments in our subsidiaries in creating infrastructure and improving supply chain, the result of which are expected to yield in the future. Also, ADF USA, one of our subsidiaries, did not contribute last year due to supply chain issues, which led to an adverse effect of 7 crores in profitability. We are closely working on the situation to mitigate these losses. We remain focused on leveraging our expertise to drive growth and profitability in the future. That's all from my side for the moment. I will now hand over the call to Shardul for the financial updates. Over to you, Shardul. Thanks.
Thank you, Vimal. Good evening, everyone. Thank you for joining us today. Let me brief you on the financial highlights for the quarter and financial year ending 31st March 2023. Standalone Q4 FY23 revenue stood at rupees 98.2 crores, which is an increase of 19% Y-on-Y. Standalone EBITDA for the quarter is rupees 28.3 crores, an increase of 99.8% year-on-year with a margin of 28.8%. That is rupees 20.3 crores, an increase of 71.8% year-on-year with a margin of 20.7%. On a full year basis, standalone revenue is rupees 353.3 crores, a growth of 17% year-on-year. As Vimal mentioned, this is the highest standalone revenue in the history of the company. Also, standalone EBITDA for FY23 is at rupees 76.8 crores with a margin of 21.7%, and PAT is rupees 60 crores with a margin of 17%. This is the highest standalone PAT and PAT margin on a full year basis for the company. In Q4 FY23, consolidated revenue grew by 13.8% to rupees 123.1 crores year-on-year, while EBITDA and PAT grew by 73.2% to rupees 26.5 crores and 42.6% year-on-year, rupees 16.1 crore respectively. For FY23, consolidated revenue grew by 6.9% to rupees 450.3 crores year-on-year, while EBITDA and PAT grew by 21.1% to rupees 80.6 crores and 15.1% year-on-year at rupees 55.9 crores respectively. The consolidated PAT has reduced because of the following reasons. One, in FY23, ADF Foods USA incurred a loss of 5 crores on account of supply chain disruption. For FY22, this business generated a top line of 32 crores and net profit of 2.5 crores. Further, in FY21 full year operations, revenue was rupees 53 crores and net profit was 6.5 crores. So the impact from the previous year is almost 7 crores at the profit level. In addition to this, the company is making meaningful investments in sales and marketing to create awareness for ADF Soul brand in India. This has resulted in a loss of rupees 2 crores. This is all from my side. We can now open the floor for question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. First question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you, Vimal bhai. Fantastic result you had posted so far. Sir, in USA we get loss. Instead, we are expanding there. So what is our main agenda for US and what things are in your mind for expand the company?
So thank you, Mr. Ravi. The US, we have 3 subsidiaries in the US.
Right.
The subsidiary which is incurred a loss is ADF Foods USA, which is the one which is handling our PJs and Nate's business. There we've had a problem with our supplier because these products are made locally in the US, and we've had some issues with them, and we are in litigation with them in the US, which is why that business did not contribute and actually is the main reason for the losses. The other two subsidiaries are, in fact, one is our distribution business, which has grown significantly since we've taken over one of our distributors in the US. And that business for us is we are moving up the value chain. We are supplying directly now to the retailers, having better control of distribution of our products, which has seen growth of our Ashoka brand also in the US because of that. So we will, and the warehouses are, the investment in the warehouses is for that business. The third subsidiary is our agency subsidiary, where we've got the Unilever and Ecotera brands agency. That business, because of the transition, Unilever sold this business to Ecotera last year. And in the transition, there were certain delays in supplies, which led to a lower sale. So these two subsidiaries of ours, the ADF Holdings and the Vibrant Food subsidiaries, are very much on track, and we'll continue to invest and grow that business, and that's going to be, you'll see the results over the coming years. The ADF Foods USA, we are looking for alternate suppliers and hope to get this matter resolved in this year.
So this supplier is in litigation. So how much the litigation fees?
So we've, Shardul, I think so far we've spent probably $60,000 on the fees, $60,000 or $75,000 on the lawyer fees so far.
Okay. So or by what time we will be settled this case likely to settle?
So we are hoping before September. I mean, the matter is in litigation. It's in the courts. So we hope to have some resolution, but that the timing is not really in our control. But we are looking for alternates for suppliers. So we hope to be able to close out on one of them again in this year itself.
So this financial year 24 will generate any revenue, any profit for US business?
Yes, that is what our endeavor is, and we are pretty sure we should be able to generate profits in the US business.
Okay. And sir, this ADF Sol you have making big in India. So are we doing any advertisement, or what strategy we are following? So there was loss in 2 crore in this business.
So for ADF Sol, that's the brand for India. We are going to launch it. We did a test launch on e-commerce platform. So we were on Amazon, and we had our own website through which we were selling. Now the plan is to expand our distribution on e-commerce, and the investments, what we are making here on the brand building is on advertising, on digital media, and this business will be in an investment mode for the next 2 years. And then after that, we expect to move into the supermarket or modern trade business, and then last would be in the general trade. So in the next 5 years, we should be across all verticals in the Indian market.
Sir, this Patanjali we have started any revenue which has been generated for company in a big way?
So, it has, not in a big way. We've done about £1 million, I think close to £1 million in revenue last year. The business started off late. Our first shipments only reached in May of last year. And we are now looking at some more products within the portfolio to be added on, and we expect this to continue to grow. We are hoping for at least 100% growth this year on that business as well.
So this Patanjali, we are looking only for Britain, not for US.
No, not for the US. We have for UK and we have for Europe as well. But for Europe, we are working on certain labeling requirements. So we hope to have that completed by September of this year, because we have to work with the company and the EU regulators to see what products can come in and how the labeling has to be done. So that process takes a little bit of time. So we hope to start the Europe business also in the second half of this year.
With such a hardship in the business, you had given a very fantastic result, Bimal Bhai. You are a magician here. Sir, this Surat facility, how much capex will they need and how much turnover it may generate when complete?
So, Ravi Bhai, we are looking at breaking ground from next month, and we expect this facility to be ready where we'll have commercial production within 18 months after we break ground. The investments out there are going to be done in two phases. Phase 1 will be a 50 crore investment. Phase 2 will be another 30 crore investment. And on the completion of phase 2, we expect this business to contribute at least 3x, minimum 3x of what we've invested. So around 250 crores is what we expect minimum that this plant will give at full capacity.
Okay. Thank you very much and all the best, sir.
Thank you. Thank you, sir.
Thank you. The next question is from the line of Rishi Maheshwari from AXA Capital. Please go ahead.
Hi. Thank you so much. And congratulations on a good set of results. I had two questions. The first one is on a presentation slide that you had pointed on slide number 21. This is on Ashoka brand. It seems like it's done fantastically well from 119 crores to 211 crores over the last 2 years. Context to that, if I had to take the total pre-packaged foods in FY21, this was about 293 crores. So the non-Ashoka brands in that year would have been about 174 crores. From there, when I look at the total pre-packaged foods in the financial year 2023, that is 362 crores. I subtract the Ashoka brands from there, about 211 crores. That leads to me on the other brands' contribution to the total revenue is about 151 crores. It seems like all the other brands seems to have declined over the last 2 years, so from 174 crores to 151 crores. I'm sure there's some context to it and you'll be able to explain, because from what I understand, whether it was Camel, whether it was Truly Indian, or whether it was Aeroplane, all of them had some form of growth over the last 2 years. So if you can explain, how do you explain this decline in growth over the last 2 years on non-Ashoka brands, and how do you see this pre-packaged foods growth going ahead? Thank you.
Okay, so your assumption on the balance part after removing the Ashoka revenue is not absolutely 100% correct, because we also have a B2B and private label business. So if you look at our whole business of the standalone entity, 30% of our revenues comes from B2B and standalone. From B2B and private label, and the 70% is the branded business. Okay. Within that 70%, Ashoka is the main part of our business, and all the other brands have grown. Shardul, you may want to share what percentage growth has been done for the other brands. And as far as going forward, we expect our Ashoka brand to continue growing aggressively. The Truly Indian brand also is another brand which we are targeting towards the mainstream. So Ashoka brand caters to the South Asian diaspora worldwide. truly Indian brand is targeted to the non-Indians or the mainstream clientele, and it's currently launched in Germany and in the US, and now we are expanding our product portfolio pipeline in the truly Indian brand in the US. So we expect growth in that brand as well in the years to come. And Shardul, you want to just give a flavor of the other brands, how they've grown in the last year?
Yeah. So just to give you context, Rishi, the B2B business, which included the bulk as well as the private label, we used to do almost 32% of our total revenue few years back, more than 30%, and down to 25%. Now, of course, we want to grow this business also, but all of our branded business, in fact, including your Camel, Aeroplane, and Truly Indian, they've all grown in these 3 years, other than the Ashoka business also.
Okay, fair enough. And so, how do you see this growth going forward? What is the expectation in terms of growth for the prepackaged food? Should we assume that this will be mid-teen growth, or it can be higher at 20% or so?
So, our endeavor is this standalone business of ours. We want to double it every 3 years. So we should be looking at growth of about 25% year on year. That's what our endeavor is. Last year, I think we've grown this by about 22 or 23% last year.
Fair enough. Thank you so much. I'll come back in the queue.
Thank you.
Thank you. The next question is on the line of Pankaj Shah from Dinero Wealth. Please go ahead.
Yeah, hi. Thank you for the opportunity. Actually, wanted to get some clarity on the margin. So, you mentioned that we'll be at the similar levels what we did in FY23, right? For the consolidated business.
Yes.
So that's around 18%.
Correct.
Okay. But actually, if we see the raw material costs have been cooling down, and further the freight rates have also corrected. So probably the right time for our margins to shoot up.
So the freight rates have softened, and that's what has helped us in the last year. Going forward also, we feel that these rates will be stable. Some of the raw materials have still not, there has been a reduction, but it's still not at pre-COVID levels, some of the raw materials. So there will be some pressure on the raw materials. And plus, because of the reduction on freight rates, etc., we have also passed on some benefit on to the consumers as well by doing some consumer offers. So we are going to try and, of course, our endeavor will be to improve on the margins, but we feel confident we'll be able to at least maintain these margins.
Okay. And other thing I wanted to understand is what are the PLI benefits that we have booked in FY23?
Shardul, you want to get that?
So as far as PLI is concerned, we have booked 8 crores of PLI income in FY23. However, I think what we have also done is in FY22 we had booked 7.5 crores of PLI, which government later on came up with a change in the scheme where the 5-year block of PLI, which was from FY22 to FY26, they changed it to FY23 to FY27. This happened post our declaration of results last year, and hence we had to do this in the current financial year. So when you see net PLI income is only 50 lakhs rupees in the current financial year.
Okay. So and this is booked under other income?
No, it comes as income from operations.
Okay, and this will be a complete 8 crore next year, 8 or plus.
Yes.
Okay. So on coming back to the PLI part, so have we increased our spending into international branding and marketing?
Yes. we have been increasing our marketing spends. Even so, the marketing spends, what we do is we have a full 360-degree approach. So we've got digital, we've got television advertising, sampling, in-store promotions. So yes, that is all. We buy shelf space. So all these things, we have accelerated and increased our spends on this.
Okay. And are we yet to see the benefits coming out of it?
Yes. This is an ongoing process in every market. As you keep launching new products, you have to promote them as well. So this will be an ongoing process, and it is definitely helping the brand grow and the awareness of the products and the brand becoming better and stronger.
Okay. Thank you so much.
Thank you.
Thank you. The next question is on the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
So we were in talks with two majors for a distribution agreement for US.
Not very clear.
Any progress in that?
Faisal, please use the handset so your voice is not.
Yeah.
We were in talks with two US based companies for two companies for US distribution. So is there any progress on inking those agreements?
So what has happened is right now in the US, we are actually, the whole Unilever business has been split into two. The new owners, Ecotera, have signed a 5-year contract, 5-year agreement with us. So we continue on with the new owners. With Unilever, we are continuing. And we are in conversation with one more, which we hope to complete off in the next few months. So yes, we are very certain that we will be at least landing one more new company for distribution in the US.
So there is still the talks are ongoing?
Yeah, it's right at the final stage. It's just, the agreement has to be signed. It's more or less at that stage. There are certain FDA requirements. We want to make sure all that gets done before we sign off, right? So packaging changes, certain formulation changes, all those have been underway, and we now hope to get everything completed within the next month or two.
So like in general trade, which you said that you want to now increase the penetration in USA, what is going to be our overall strategy, and how much have we penetrated so far in the US? That's one. And second is for modern trade, like, for Walmart and also, do you have any data as to how many stores you may be present in at this point of time, and how many other stores which we can, where there is an Indian diaspora, where we can probably aim to penetrate with our products? And do we have any schemes for universities where a lot of Indian students are studying? So are we trying to to penetrate those areas also on an independent basis?
Yes. Yeah. So there are three verticals, as you rightly mentioned. One is the general trade is more what you are referring to, is which caters to the South Asian diaspora. And our company has a very strong distribution network where we have 2 locations which we are servicing directly the retailer, and the other locations are being serviced by another 10 of our distributors in those markets. We continue to grow in that business. We continue to expand our presence on the shelves, increase the penetration and the width of our distribution in these stores. The Ashoka brand primarily is sold through these outlets in the US. The second part is the mainstream part, which is modern trade, which you call. That is something, the truly Indian brand, as I mentioned earlier, that is the brand which we intend to grow in the US market. At the moment, it is a very negligible reach that we have there. We hope to expand that in the years to come and be a dominant player in there. So it's not just the supermarkets. We are also targeting club stores like Costco and Sam's Club, which also cater to the non-Indian diaspora or the mainstream diaspora. So that is still work in progress, but we see a huge runway on that in that market for us. And the third one, where you talk about the college stores and campuses, that falls under a different vertical. So the US is, in the US market, there are different verticals for all this and different distribution channels. And this falls under the food service channel. And we have, in fact, just appointed a new head of food service who joins us from the middle of, in fact, from the 15th of May, which is next week. She joins in, and our goal is to cater to get into the food service side, which means restaurants, college campuses, commissaries, and then there are convenience stores on college campuses. So that all comes under the food service side, and that will all be under the Truly Indian brand. So that's also something which we are starting off now.
So would it be a good statement to make that, a year from today, when the Surat facility is on stream, we would be then, safely growing like 20% year on year for the next 3 to 3.5 years?
Yes, that is what that is our plan, and that's why these investments are being made, so that when we have the market ready for it, we have the back end also available for us.
So we have still not even penetrated a Sam's Club or Costco as yet. So I mean, that's like a huge opportunity which could really open up, and the kind of the way they promote the products, so exclusively. I think that could be a big breakthrough for us.
Absolutely right. And that's why even in the Surat facility, even though we are that's why we are doing phase 1, phase 2, and then we can even do a phase 3 there, because we've got a large parcel of land there, so we have scope to expand in that facility as and when required.
Thanks a lot. I think we have a long way to go, and we are doing pretty well. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rasna Koza from 9 Basic Research. Please go ahead.
Yeah, thanks for the opportunity. So my question was on the PLI scheme. On slide 20, you mentioned that the maximum incentives you can get from PLI scheme is around 61.35 crores, out of which I think we have booked around 8 crores. Can you give us some path of how the balance can be booked? Because I presume it is to be received between FY23 to 28 over a 5-year window. Some color on how the calculation is done, and what kind of incentives will book in the next 3 years, year-to-year basis.
So I'm going to let Shardul answer that, but the whole PLI scheme has been for marketing and brand promotion. So we will continue to invest on that front, because that is we have been granted the scheme under that heading, and how it's going to be broken up, Shardul will give you more details on that over the next 4 years, how we'll be claiming that.
Right. So the way it's going to work is every year the amount is going to go up because it's based on the top line growth which we will achieve, and that's how the projections have been given to the government, and based on that they have given us the sanction. So 61.35 crores for us to get this, we'll have to spend 123 crores. So 50% of that will come back from the government. Now this is over a period of FY23 to FY27. Those are the 5 years in which we have to spend this money and get this money. And also every year the top line will grow, say assuming 20-25% growth will happen. We will get this money based on the top line percentage also.
So does it mean that 8 crores going up to 10 plus next year, then to 12? That's the path one can look at?
Yes, amount may differ, what you just mentioned, but what you say is correct. So in the last year, it will go up to almost, say, 15, 16 odd crores also.
Okay. And I think you all had mentioned earlier this is booked in other operational income, right?
Correct.
Okay. Thanks for this clarity and best of luck.
Thank you.
Thank you.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is from the line of Hatim Rochwala from JM Financial. Please go ahead. Sorry, JM Mutual Fund.
Hi, sir.
Hi.
Thank you for the opportunity. Sir, one question I have is that when we say that the margins are sustainable at current levels, so are we referring to the yearly margin or we are referring to the Q4 margins?
No, we're referring to the yearly margins. We should be able to improve it further. But the Q4 was a exceptional quarter. Our endeavor will be to try and be as close to the Q4 numbers in terms of margins. But on the safer side, we're going to be looking at the annualized gross margins.
Sir, are there any one-off levers in the Q4 margins? Because there's a very big gap between our yearly margins and Q4 margins. Or are there any seasonal effects which has led to very high Q4 margins?
Shardul, you want to get that? So when we are talking about the margins, I'm talking about the standalone ones and not the consolidated. But Shardul, you may want to give some clarity on this to them.
Sure. So Hatim, the main reason why the margins are high is the freight cost, which has come down. In the beginning of the year, we're at around 20% to now it's around 8%. So that's the main variation which has happened in terms of cost structure. But I think what will happen is some of this benefit, as Vimal just mentioned, we will also pass it on to the customers by way of consumer offers and those stuff. So though there is no exceptional item here and the margin that the cost structure will remain like Q4, we will have to pass on some of the benefits to the customers. And hence, we are sticking to the annual number.
And are there any seasonal variations in margins in our business? Apart from the adjustment which you will be making, but keeping aside that, are there any seasonal variations in our margins?
Not really, but our top line in H2 is generally stronger than H1, and within H1 also Q2 will be stronger than Q1. So what happens is your fixed cost apportionment in that quarter will show a slight decline in say from Q1, and then it will start moving up in quarters to come. So there is no seasonality as such, but seasonality is in terms of the top line is what we achieve. So that's that.
Okay. Thank you and all the best.
Thanks, Hatim.
Thank you. The next question is from the line of Ranjit Zaveri from Zaveri Consultant. Please go ahead.
Hello.
Yes, please go ahead.
Yeah.
Sorry, your voice is breaking, Ranjit. I request you to come in the network area.
Hello.
Yes.
Now it's clear?
It's clear now.
Yeah. So congratulations on a good set of numbers, and especially on the margin front. Sir, questions on our global brands. So wanted to ask, what would be a reasonable timeline for resolution of US supply chain issues related to PJs and nets?
with our current co-packer, as I mentioned, we are in litigation with them. So we don't know how long that would last. We are hoping by September we should have some resolution on that part. And we are in discussions with another co-packer for manufacturing those products for us. So that also we hope to have some resolution and approvals on that facility, both commercial and technical, by September of this year.
Okay. And sir, what is the margin profile for this business on gross and EBITDA basis? Any ballpark number if you can throw?
So, right now we need to work out the commercials with the new co-packer, so it's going to be difficult for me to give you any margin numbers. But earlier, this business used to generate about 12 to 15% EBITDA for us.
Okay. And so one just last question. So the products of PJs and nets, where they will be sold? They will be sold to big box retailers or small local stores. And revenue expectations.
No,
yeah.
They are typically sold in all the modern trade outlets. So within the supermarkets, that's where it's sold. So what will happen now for us is that we will need to, once the brand has been now out of the market for about a little over a year, it would entail, again, going back to the retailers, relisting the product. So that could take a little bit of time. That's why I can't give any guidance on how that will work out immediately. So we first need to have the co-packer ready and then start going out with the products into the marketplace. But the other businesses which we are looking at on the truly Indian side, those businesses are something which is already in the pipeline, so we should start seeing some positive results coming out of that on both the food service and the supermarket side of the business. On the truly Indian, we expect that to happen much faster this year.
Okay. And so just the last, any revenue guidance once the production resumes?
On the PJ's mates, like I said, it's going to be very difficult for me to give a guidance till we've tied up all these loose ends and start approaching the retailers again.
Oh, okay. Thank you, sir. All the best.
Thank you.
Thank you. A reminder to our participants, please press star and 1 to ask a question. The next question is on the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Sir, I joined the call a bit late. I just want to know now from the supply side how we are positioned. First, with respect to the lease plan that we had taken, and then with respect to the greenfield that we are going to put up. So, how are we stacked up on the supply side now?
So we are in a comfortable position at the moment. Our debottlenecking has happened in the Nadiad and Nasik factories, so that has helped in increasing capacity. The lease plant, we are continuing out there as well. The greenfield project, we are going to break ground from next month, so we expect that to be ready in 18 months from the time we break ground. Hello?
It seems that we have lost the line for Pritesh.
Okay.
We will move to our next question. That is from the line of Anup from First Impression. Please go ahead.
Yeah, hi. I was just wanting to know about your investment in Nonsense, which you had talked about last year.
Yeah, so I think you might have missed out, Anish. We decided not to pursue that opportunity, and we in fact gave information to the stock exchange also on that we are not pursuing this.
All right, thank you. I missed it. Sure.
Thank you. Next question is from the line of Ankit Shah from Dinero Wealth. Please go ahead.
Actually, it has already been answered. Just wanted to understand about the US subsidiary which is loss-making and contributed 5 crore loss. So was wanting to understand that the outlook for this FY24 is that probably the losses won't be there and some contribution to revenue will also come into play.
Sorry, Pankit, your voice is not very clear.
So I said it's partially answered. Just wanted to clarify that the US subsidiary which contributed 5 crore loss for FY23, so next year the outlook is the losses won't be there and probably some contribution to revenue will also flow in, right?
Yes, we will. We are hoping to have some positive contribution next year. And of course, we are doing everything to tone down the losses which we incurred last year. So it is going to take some time for it to turn around, but it's obviously going to be a lot better than what happened last year for us on the ADF Foods side.
Okay. And if you can throw some light on the acquisition side, if you are currently actively looking for it or we are close to something, and how are we placed?
So, we constantly get proposals. We keep evaluating them. In fact, there was something which we evaluated a few months back, but decided not to pursue it because it was expensive. Currently, also, there are a couple of proposals which we are evaluating. So as and when we have something more concrete, we will definitely make the announcement. But yes, this is something which we are actively pursuing and aggressively trying to see what we can get in our fold.
And what would be the thought process behind looking for an acquisition? So the earlier one which we decided, which you called off, that was probably an indirect one, right? Looking for a direct presence or a brand or a area where we aren't present as such. What is the thought process behind it?
So the last one was more to move up the value chain and have better control over our distribution, right? So we will, and that has helped our business this year as well. And we continue to look at that side of acquiring businesses. And plus, we are also evaluating complementary products with a brand and distribution as well. So we are looking at both these. We are not looking at anything in India because the valuations in India are very high. We are getting much better value propositions from the international markets, and US being one of our main markets, we are keenly looking at opportunities in the US.
Okay, great. Thank you.
Thanks.
Thank you. The next question is a follow-up question from Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yeah, sorry, sir, that line got disconnected. So you said that debottlenecking has happened in 2 plants. The lease plant is operational, and you are saying something more.
No, the lease plant continues to produce, and the new greenfield project, as I mentioned, we'll be breaking ground next month and hope to have it ready, phase 1 ready within 18 months. And then, so we are on track as far as capacities go. At the moment, we have no problems at the moment.
So this debottlenecking and lease plant, which you have for, let's say, the next 24 months, what kind of top line it can support?
So Shardul, you want to get this, please?
So the debottlenecking which we have done in our existing plant in Nadia and Nashik, one is we have spent 5 crores in the last financial year and almost 20 crores in last 2 years. So we have already created, with this 20 crores, we have created revenue potential of almost 100 CR. For debottlenecking, which we have been doing in last couple of years. The greenfield which we are doing, that's going to give us, in fact, Vimal mentioned this, is 80 crores total capex we'll be spending, and we are looking at 3x top line from it. So that's the kind of growth which we'll get from the capex which we are planning to do.
No, I asked you on the lease plant, sir.
We have not done any debottlenecking. Lease plant is.
No, I'm asking, sir, what is the revenue potential out of the lease plant?
Can I take that, Shardul?
Yeah, Kiran,
Yeah, the lease plant will give us a revenue and a full revenue potential of about 30 crores.
Okay, so that explains. So basically, 130 crore of business you can do out of which something would have flowed in FY23, right? Out of the 130.
Yes.
Right. So so let's say a residual of 80-90 crores is possible.
Yes.
Right, because 335 went to 360, that's 30. So basically, let's say about 100 crores is possible from your existing setup over the next 2 years. You have that capacity, whether it's possible or not, but you have that capacity.
Yes.
Okay.
Correct.
Okay. My second question is, sir, on the distribution side, we were looking at, a slightly faster growth and some tie-ups and all. What happened on the distribution side? Any progress, and why is the growth not emerging?
So what happened last year was, as you know, we had some of the Unilever specialty brands which we were distributing in the US and in the UK. Last year, Unilever Worldwide decided to hive off their tea business to another private equity. So that during that whole transition process, there were the transition wasn't as smooth as anticipated, and there were certain disruptions in the supply of products, which led to a degrowth of business on the distribution side. Now things have gotten back to normal, and this year we are expecting the Ecotera side of the business, the tea side of the business, which has now been acquired by Ecotera. We expect that to grow, and we have the Patanjali business in UK, Europe, which will also grow for us. That started off late for us last year. So this year we expect that to double up in size, and we are planning to open up Europe as well with the Patanjali products. And we are also close to tying up one more distribution agency, which hopefully within the next 2 months we will have that tied in. So by the time the supplies come in, it will be by September that we would have started off with that with the new agency as well.
So what kind of growth is possible here in the distribution business?
So this year, Shardul, what is it that we have? What are the guidance on the distribution side?
So this business will give us around 10 to 15% growth.
With all these additions, Patanjali.
No, not considering the new agency. So with the new agency, since we'll only have half a year, it will probably be, I would safely say, around 15 to 20% growth we should expect from this distribution business. But our core business, which is our own brands, that is where we are looking at a 25% growth, around 25% growth.
Okay. And last question, I couldn't comprehend that co-packer issue that you have, which is going to resolve over 6 months. What kind of top line is it?
So as I mentioned, that is we still have to. We are in discussions with another co-packer. There is technical and commercial arrangements which are still being ironed out. And then after that is done, your brands have been off the shelf for over a year and a half. So getting back onto the shelves is not a very simple process. So it's very difficult for us to give guidance on, once we've tied in with the co-packer, what kind of revenue growth we can look at, or what kind of revenue we can look at from those brands in this year. But we have the truly Indian brand, which we are promoting and expanding in the US, which has just started. So we expect this ADF Foods USA, which is the entity which does the PJ's Mates, and will be doing the truly Indian brand. We expect that to at least have, last year it was a huge negative contributor. This year we at least expect it to contribute positively and not have the kind of loss we've had last year.
So this 25% growth that you mentioned is without assuming anything on that co-packer dependent brands, right? That's
Yes.
right.
Yes,
And
absolutely.
this co-packer dependent brands, when they were normal, what kind of contribution to sales it had? What percentage of sales it had?
So last year, Shardul, how much was considered? I think close to 37 crores or 40 crores.
32 crores top line was there and 2.5 crores of profits were there last year.
Last year means 23 or 22?
FY22, sorry.
So 22 it was 30 crore, which was not there in 23.
Yeah.
Correct.
Right. So there was a 30.
Hardly anything.
So there was a 30 crore impact on account of it. So if you adjust for that, the growth would be 20%.
Correct.
Right, in the processed and preserved foods.
Yes.
Okay. Thank you, sir. All the best to you.
Thank you.
Thank you. A reminder to our participants, please press star and one to ask a question. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Bimal Thakur for closing remarks. Thank you, and over to you, sir.
Thank you very much for your participation, and I look forward to connecting with you all in our next earnings call. Thanks, and have a good evening.
Thank you very much. Ladies and gentlemen, on behalf of ADF Foods Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.